My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Got to be one of my friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Every time President Trump says something inflammatory that panics Wall Street and sends the stock market plummeting, like we saw on Friday, you got to remember that this president doesn't want stocks to go down. He wants stocks to go higher. And that's how you get a day like today where the Dow gained 270 points, S&P climbed 1.1%, and the Nasdaq pole vault 1.32%. Trump knew that things looked bad after Friday's sell-off. So he decided to say something positive about the negotiations with China, and that turned things around. Did he call them? Did they call him? Was there even a call? People, that's almost beside the point. On Friday, the president took a harsh stance, talking about boosting tariffs and demanding that American companies leave China immediately. Now he says the Chinese called him and they're willing to negotiate. That was enough to give the market some lift, even though we're getting conflicting reports about what really happened. We know the People's Republic has officially denied that anyone called Trump. On the other hand, Trump says he got 2 calls because the Chinese are desperate and they know he has the upper hand. Who's telling the truth? I got to tell you, I was amazed at how quickly most of the media rushed to decide that the Chinese Communist Party is more credible than the White House. Don't be wrong. I recognize that our president likes to engage in what he calls truthful hyperbole. But China is an authoritarian one-party state. It's not like their government has any reputation whatsoever for honesty. More importantly, we don't care. We don't care who did what. We care what they're saying publicly. I mean, Trump's signaling a willingness to deal. China's chief negotiator, Vice Premier Liu He, says he's willing to resolve things through consultation and cooperation. Remember, this trade war is much worse for China than it is for us. And if you don't believe that, you're just not willing to accept facts. They're being hurt by the tariffs, and they need a deal. Maybe they just want the trade war to calm down while they try to address the increasingly violent protests in Hong Kong and the loss of face that they're having there, although the media never mentions that. But here's what really matters to your portfolio, because this is mad money. President Trump views the stock market as the equivalent of his Nielsen ratings. If he does something that makes the market go down time after time, he's shown a willingness to change course so that stocks can go back up. That's why it's almost always a mistake to sell into the teeth of presidential tweet and do sell-off like it was on Friday. If you want to take something off the table now that the market's bouncing back, hey, be my guest. The important thing, though, is that you got to filter out the emotional day-to-day noise so you can make a clear-eyed assessment of what's really going on here. Let me tell you what I see. First, I still believe a quick trade deal is highly unlikely. The White House isn't trying to get China to just buy more American-made agricultural equipment or foodstuffs these days. We are long past that. The president wants the Chinese government to cut out their many unfair trade practices, which would amount to a wholesale change in how the PRC does business. He wants American companies out of China pronto because they won't change. I think you need to view these on-again, off-again negotiations as a way of giving U.S. companies more time to pull up stakes and leave. The bluster always contains the same rhetoric about this stuff. You got to understand, Trump believes his tariffs can cause a serious recession in China, which would give him the upper hand, let him win real concessions, and he doesn't care about the cost to us or the rest of the world. World war. Who knows? It may be an exaggeration when Trump says they're losing billions of dollars and millions of jobs, so the tariffs are indeed hurting them. Second, while the president's willing to tweet harsh words and risk a big decline in the stock market, if that decline is too big, he will always turn around and say something positive. He's done it time and again. How long will it take Wall Street, particularly the pajama traders, to learn? However, at the end of the day, Trump cares more about beating the Chinese than he cares about pushing the stock market higher. If the market was his number one priority, we wouldn't have a trade war at all. So while you can count on Trump to soften the blow after a big decline, sooner or later he'll go right back to his more bellicose rhetoric. I don't blame him. This crackdown on China's unfair trade practices was a long time coming. Third, any publicly traded U.S. company that stays in China, well, their stocks are going to get lower valuations in the stock market as long as the trade war goes on. If your business depends on China for its sales or its supplies, you're going to pay a price here, and the White House doesn't care if those stocks go down. The White House actually wants to see that. The president accepts that some companies will simply move to Vietnam, although he's wary of transshipments from China. So American companies even need to be careful that they aren't simply buying Chinese goods routed through Vietnam. He'd prefer Indonesia or Malaysia, Although ideally he wants these companies, of course, to come back to the United States. But when he orders American companies to leave China, the whole strategy is that the stock market will do his lifting, his heavy lifting, in terms of punishing anyone who doesn't listen. Maybe you think that's too sophisticated for the White House. I think it's intentional, but whether it's part of the plan or not, it's absolutely happening. Finally, and this is a toughie, our industrial economy is absolutely getting hurt because of the tariffs. There's a visible slowdown in manufacturing as measured by rail car loadings, lumber, plastic pricing, auto sales, linerboard, high-end home purchases. So if you have a lot of exposure to the industrials, I think you need to do some swapping. That's right. Sell something and move into something less cyclical. I recommend moving into nice, consistent companies with good balance sheets and high dividends. That means Verizon with a 4.2% yield, but not AT&T with its more precarious nearly 6% yield. AT&T's balance sheet isn't good enough. I want you to review the good REITs like a Ventas or a Vici. There's also gold. We like Barrick. We like Agnico Eagle. If you just keep your money in an index fund, I don't think there's really that much you can do here. You got to ride things out, expecting more volatility, even though it can leave you bruised, pain, because it's too hard to swap out and then swap back in at just the right moment. We don't play that game with Mad Money. However, you might want to raise your cash position on these strong days to at least 10% of your portfolio. This is going to be a long slog. You need to be prepared for more pain. And you need to be able to buy that pain, even if the pain, well, let's just say, is painful. Bottom line, whether or not China wants to make a deal, from what I can tell, President Trump believes the longer he holds out, the better, which means we haven't seen the last of these brutal sell-offs. So get used to them. And next time, remember, there's almost always a bounce after the worst of the carnage because he wants one. Let's go to Jordan in Rhode Island. Jordan.
Booyah, Jim, from a 28-year-old bootstrapping robotics entrepreneur from the smallest state of the union.
There you go. I love that. I love you. I love that you're calling 28-year-olds. See, no, only 75-year-old people are interested in stocks. Okay.
Well, my question is on the company McDermott International. Their last two earnings calls were pretty bad. They have another one coming up. Revenues are decent and some good volume activity. It's some attractive float there. There's a few press releases on some new contracts that they won, and there's estimates all over the place on their price. I just wanted to ask you, do you see the potentiality with all these issues with global trade and China for energy to possibly give us a little bit of a safe haven to hedge against all the commotion that's going on?
I think that this is a go-away industry. I don't want to be there. I have nothing positive to say about the group. Nothing at all. Ken in New Jersey. Ken.
Hey, Jim. My question today is about IBM. I bought it at about 143, and I'm down about 10% since acquiring it. Two questions. Is this stock safe from the trade war? And how safe is that 5% yield now?
I think the 5% yield is incredibly safe. I don't think that there is China exposure. There's no doubt about that. But the Red Hat deal has made it so that it's worth being in. I see more pain simply because people hate the stock. But there's really no reason to despise it as much as the sellers do now. It makes no sense to me. All right. There's two certainties in this market. The first, President Trump wants stocks to go higher. And two, the trade war is staying power. Expect things to, let's say, be more volatile until something shakes out, whatever that may be. Until then, reduce your exposure to the industrials and buy the stocks of companies with sustainable high yields and good balance sheets. Hey, on Mad Tonight, are consumers still spending on their Venti triple cappuccinos? The ones with skim like I order? I'm talking to the CEO of Starbucks to find out. Then, have you heard about the war that's broken out this month? No, we're not talking about the trade war. We're talking about the great sandwich debate of 2020. I'm looking for ways to profit off of chicken sandwich mania that's ruffling feathers across the U.S. And how a $7.6 billion deal is transforming the animal health space. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.